Good evening and welcome to this week's edition of Virtual Office Hours. We'll get started here in a minute, so just bear with us as everyone joins the room, then we'll get started. Thank you so much. Hello and good evening, and thank you for everyone who's tuning in to this week's edition of Virtual Office Hours. We have a very exciting panel discussion here today to talk about Kenya's real estate industry. There's a few key things we're going to be covering today, i.e. recent changes and trends within specifically Nairobi's investments landscape. And then we will also be talking about the role that the diaspora is playing in the industry, and then also how the diaspora can take part in Nairobi's real estate boom. So thank you so much. For those of you who don't know me, my name is Andrew Barden, the CEO of the Kenyan Wall Street. We have some amazing panelists here today and one more who may be joining us here in a little bit. But to get started, I'd love to begin with a round of introductions. So allow me to pass first introduction over to Mr. Samuel Kariuki.
Thanks, Andrew. Good evening, everyone. And I assume it's good morning for others, depending on where you are tuning in from. I'm Sam Kariuki. I'm the CEO of Vida Homes. We are a real estate developer based in Kenya. Nairobi primarily is where we develop. We develop green, affordable, and mid-market housing. Opportunistically, we may do high-end homes. Currently, we are owned by Actis. Actis is a well-known investor in emerging markets around the world, focusing primarily on real estate and sustainable infrastructure. We are based at Garden City, a large mixed-use development where our flagship projects are, but we do have a number of other projects in and around Nairobi. Thank you.
Thank you so much, Samuel. Carol, care to take it forward?
Oh, good evening or good morning, everyone, wherever you are in the world. My name is Carol Musyoka, and I own my own boutique corporate governance consultancy called Carol Musyoka Consulting Limited. I'm a former banker. I worked in the banking industry for over 10 years, and now I'm just a rabble-rouser and noisemaker, occasional columnist, and just happy to be here. And I comment on a lot of things going on the business and economic side of Kenya. Thank you.
Thank you so much. Dr. Shem. Dr. Shem, I believe you're on mute. Can you hit the unmute button? There you are.
Thank you very much. Thanks, Andrew. Good afternoon, good morning, good night for those in Australasia. Shem is my name. I'm Global Chair, Kenya Diaspora Alliance, and Co-President, Africa Diaspora Alliance. I've been in diaspora matters 30 plus years, literally in all continents of the world except South America. And I firmly believe, and we believe so at KDA and AfDA, that diaspora is going to be the gold that we need to mine to move forward our country and our continent. And I'm happy to be here. KDA itself is a federation of 67 diaspora organizations, bring together a little over 350,000 Kenyans across the globe. Looking forward to this meeting. Thanks.
Thank you so much, everyone. One of the key parts of this discussion is the role of the diaspora here in Kenya. And so I have a few quick graphics to kind of help us set the stage on what's taking place and the very large impact that the diaspora has on the Kenyan economy. So I guess a little bit of background knowledge. And Dr. Shem, you know, if I say anything incorrect, you correct me. You're the man for all that information. So from what we've learned, there are about 3 to 4 million Kenyans within the diaspora. In 2024, the Kenyan diaspora contributed $4.95 billion to the economy in the form of remittances. And the role that the diaspora is playing in the economy is so outsized that even recently CS of Treasury John Mbadi had mentioned that there are plans to launch a diaspora bond. So there's a lot taking place on that front. and such. So Dr. Shem, I guess to kick us off, what is the role of the Kenyan diaspora precisely on the Kenyan economy?
Thank you, Andrew. Maybe at the continental level, diasporas inject into Africa, hoping $100 billion every year. The bulk of that 30 billion goes into Egypt, 25 billion to Nigeria, 9 billion to Morocco, between 4 to 5 billion to Kenya, Ghana, and Eritrea. For Kenya, diaspora remittances is double what we get from all our three top agricultural exports. That's tea, horticulture, and coffee put together, that bring nearly $2.4 billion in a good year. Tourism has gone up, but still what we get from tourism is about half the remittances of the diaspora. So correctly, diasporas are the new sheriff in town, and we're glad that this is being appreciated. 30 years ago, we didn't even have a desk at Foreign Affairs dealing with diaspora. Now there's not only a desk, there is a directorate, and there is a State Department. And as Kenya Diaspora Alliance, we're still looking for a full ministry, maybe with 3 State Departments, because diaspora is huge. And lastly, just to say, the $500 billion Kenya shillings, I think it was 670 billion Kenya shillings last year, that diaspora remit into the country is only 5 to 10% of what they could bring in. One of our members in Norway did a study, found 90 to 95% of the potential investment or remittance remains outside. Hoping, working together with Vida and Kenya Wall Street, we can unlock, maybe even double that amount within the next 5 years to become 1 trillion Kenya shillings into the economy. Over to you, Andrew.
Awesome. Thank you so much. And Mwenda has been able to join us. Mwenda, sorry for starting without you, but welcome to show business.
Oh, thank you. Thank you so much. Yes,
absolutely. Would you care to introduce yourself, what you do?
Yeah, sure. My name is Mwenda, Thuranira-CEO of a real estate company known as MySpace Properties. MySpace Property deals with all the facets of real estate, from real estate development, real estate management, real estate marketing, real estate sales. I mean, in all the facets of real estate, we are there. And of late, we have been focusing more on commercial real estate. And that's me in a nutshell.
Okay. Well, thank you so much for that. Now, the core of this conversation is about, the state of Kenya's real estate industry. So I think, Samuel, you'd be a great one to answer this next question. What do we need to know about the current state of real estate here in Nairobi and in Kenya as a whole?
Okay. Thanks for that, Andrew. I suppose it helps to answer the question by looking at what are the key themes, the key drivers that have been driving real estate trends in the country. And I like to look at the Kenyan economy and hence the real estate industry at two significant points, the pre-2002 and the post-2002. You will agree with me, the last 20 years and certainly the last 15 or so have seen probably the most significant investment in infrastructure compared to all the years since independence and up to 2002. That has led to opening up of not just Nairobi, but all surrounding counties and other counties, linkages to Nairobi. Previously areas that would have been considered rural are now, solid urban or peri-urban areas. It's an important point. There's the significant investment in infrastructure is very visible as you drive, around Nairobi metropolis, but also the country. The other one is the 2010 new constitution, and how that is relevant to us today is that in addition to Nairobi and Mombasa and Kisumu, which were cities before then, and in addition to these 2 new latest cities, what devolution has ended up doing is creating what I would call new centers of economic activity. And therefore, as you drive to sort of the next big towns, you are noticing a trend where there's some level of new supply of all manner of the different segments of real estate, be they residential, primarily residential, but also new shopping centers coming up. So you are seeing a bit of primary economic activities moving from Nairobi to the next tier, Nairobi and the big towns to the next tier of towns, and that in itself is creating opportunities for real estate investments below what I would call the top 5 cities. Relative to that, obviously, is the urbanization trends. I was looking at some statistics today that seem to suggest Nairobi and the surrounding metropolis area is growing by 400,000 people on an annual basis. It's a huge demand. And you can imagine yes, 400K. You can imagine the sort of demand that is driving not just for housing, but for the sort of retail centers, for example, that Mwenda develops. Obviously, with new housing demand comes new housing for new demand for retail centers. Comes new requirement for goods, and therefore you're talking of new demand for logistics centers, for example. So I think I see those as the key themes and the general key trends, and all these economic sort of, depending on where you sit, on the paradigm, and your own views on how the economy is going. However you look at it, I suppose the fundamentals still support growing demand and therefore growing investment opportunities across the various segments of real estate. And we remain, despite the economic hindrance, which we see as being short term, we still remain very bullish, especially on certain segments of real estate.
Okay, and Mwenda, I want to pass the question over to you. We've been seeing quite a differing trend in commercial real estate recently, focusing on, things as Samuel had alluded to, malls, different shopping centers and such. What is your take on the state of real estate here in Nairobi, but from the perspective more of commercial?
Okay, first and foremost, take on the state of real estate here in Kenya. And one thing I can tell you is 60% of Kenya wealth is stored in real estate. And it's valued at around 773 billion around the country. And 10% of that being commercial real estate. So commercial real estate, we are still lacking behind. But when it comes to, if you look at places like Kilimani, Kileleshwa, Lavington, many people really focused on building apartments, houses, townhouses, and everybody forgot where these people need to take coffee, where these people need to go for shopping. They need to go to a supermarket, they need to go to an hair salon. So all these things are important to build a community. So when it comes to shopping centers, basically what we are doing is we are modernizing the kiosks. The kiosk which used to go around the corner, now it's become a minimum. And that's the trend is going, since we are selling convenience, where people can go in and out fast. Like a mall, you have to go through checking system, go through paying parking and stuff like that, which is discouraging and inconveniencing. In fact, the parking process takes 20 minutes of someone's time. So when you go directly park, go to the supermarket, get out and go, people are liking that more than the other traditional way.
Okay, interesting. And, the Kenyan Wall Street earlier this week published an article, let me pop it up real quick, titled "Diaspora Shifts Investment from Land to Cash Flow Generating Real Estate." And what this was following a trend of different things that our team has seen, and from, experts like yourself as well, where not just the Kenyan diaspora, but the global African diaspora is looking at Nairobi's real estate space and saying, hey, how can I make money off of this rather than, simply acquiring land? There's been a huge focus on cash flow and convenience from real estate investment. So I want to, move to the next question of what are some of the key challenges that specifically diaspora faces when investing in real estate, and then how do they overcome those challenges?
That is for me.
Would you like to comment on that? You're our diaspora expert.
That's for Shem.
Is it me, Andrew? Yes. Should
Yes.
I go?
Yes,
Okay.
please.
The greatest challenge for diaspora investments is, I could sum it in one word: trust. As Kenya Diaspora Alliance, one thing we've taken for the next 3 years is to focus on trust building, restoring trust. There have been horror stories we have had, sometimes from people even sending money to relatives. And then, of course, you can't take relatives to court. They use this money. There was fees. There was this need and that. And then sometimes they send pictures of other people's properties when they get home. And diasporas don't get home too often. Most diasporas I know in a year get to Kenya for just a window of 2 weeks in a year. And within that 2 weeks, there's so much to do that they can't cover much. So trust deficit is the biggest problem. Obviously, the way to address it is to have products that are trusted. As Kenya Diaspora Alliance, something we've started doing with other sectors is to identify service providers of choice. Ultimately, we'll be doing realtors of choice. I'd be very surprised if Vida and MySpace are not part of that, but I'll leave it to the panelists when we get there. So, for example, for group last expense cover, insurance cover, we already selected 4 companies competitively, transparently, out of 25 of the top insurance firms, local and global. And we will be doing that, of course, getting feedback also from diasporas. What are their experiences? So as KDA, brands that we put our seal on are trusted brands. So obviously, if we come up with those products that are trusted, we're likely to see a growth in more investment. Secondly, government may also need to secure investments. I remember 3 years ago, in collaboration with the University of North Carolina, we did a study. One of the questions to the diaspora, probably the biggest survey ever done on Kenyan diaspora, was asking them, if Kenya government say, tell us just one most important thing, if we did today, you would feel belonging. The second thing they reported on was, we want our investments and assets in Kenya protected. So security of investments, a major one, both at the national and county level. And we're glad some county governments are already taking this seriously, like the national government is doing. But I think those are trust is the major challenge. Over to you.
Okay, yeah, and working with firms like Vida and others, that really seems to solve that trust issue. Samuel, do you care to comment on that? And how are developers like yourselves helping solve that trust deficit?
And Andrew, if I could just weigh in here for a minute. There's 2 things with regards to a diaspora purchasing, and I'm throwing a guess here, property in Kenya. So there's purchase of land. So first of all, are you buying a genuine property? And then there's adding value to that land, which is either building a house or making it into a commercial entity, or getting in terms of planting crops or putting up animals. So there's 2. So to Shem's point about the trust deficit, we also first have to start addressing what is it that you're doing. Now, there are institutions that cater specifically to the diaspora that have now become trusted, that go out, do the land banking, and then go out and sell to the diaspora. One institution I can think of that I know does a pretty good job is AMG Realtors, who about 80% of their clients are just diaspora. And what do? You'll be able to buy your property when you're abroad, and pretty much know that your property is safe and secure, and it's not being taken over because it's within a certain neighborhood of other people who are also purchasing from the same company. Then the second challenge then comes in, as Shem has said, about how are you going to develop that since you're abroad? So it's a view that you take if you're in the diaspora. Am I land banking and then I'll come and develop it myself? Or am I purchasing with a view to developing, and then now the Mividas and everybody then comes in, or whoever this group of people that are looking for trusted partners then come in to add value to that property. But one thing that we have, a fascination that completely befuddles me as a Kenyan, is we have a fascination with land. We just want to buy a piece of, even if it's 60 by 100, and say, this is my piece of land. That just blows my mind. Whereas purchasing finished assets that classic good developers are doing could be a much better way of of placing your money and drawing an income immediately from passive income. Let me pause there.
No, we love land, don't we? We probably are the only country where we view land as a commodity and not a raw material or input to something else. But just to contribute to that, on that trust, because that's a key issue for diaspora. The real estate market, and specifically when I look at the residential market, has for long been characterized by what I would call mom and pop shops. Kenya residential sector is a very fragmented sector. We haven't had until recently what I would call institutional quality developers, corporate level developers. And Caro is a governance expert. It's people who would fall under what Caro would call well-governed, corporations with boards and who care more about their very long-term brand. 95% plus of supply of residential, say in Nairobi today, is, Shem has a quarter of an acre or buys that 100 by 100, decides to put up a 6-story or something like that. That has been an issue. He may or may not finish, especially if he's using a deposit. Now, because we in our industry have to take your deposit, and therefore on day one, what we are selling you, so I'm taking your deposits, making a promise of something I'll need to deliver in the future. I am, for all intents and purposes, a public interest entity. I'm just not defined as such. But I'm holding on my balance sheet, cash deposits belonging to people, which money does not belong to me until such a time that, I fulfill my obligations towards them. And unfortunately, we've had instances where people in our industry have broken that trust, created a credibility sort of crisis in our industry, which is why, to Shem's point, I would insist, if you're in the diaspora, you're looking to invest back home, obviously, just like any investment, due diligence is key. And I always say, deal with institutional, developers or institutional real estate companies. Yeah, that is key. You wouldn't compromise. The same way you wouldn't place your savings account in some entity that is not regulated. When it comes to real estate, it's no different. It has to be an institutional developer or institutional real estate company.
Okay, and there's a few key factors that specifically impact the diaspora more than local investors, such as currency fluctuation, specific taxation policy, even accessing financing as well. I'm curious, what opportunities are there available, maybe even financial products, specific institutions that can cater to the diaspora investors, looking to move into the market?
Carol, do you want to speak on the finance before I chip in?
Yeah, I mean, Andrew, there's so again, and I love the comments that are coming through, and it's actually somebody has really pointed out to real estate investment trusts that looks at that, somebody who's outside, who's looking to come in through a structured entity, structured institution that has the right governance, that is regulated by the Capital Markets Authority. So that's one avenue to do that. The challenge with the real estate investment trust is that let me say the challenge. The benefit is that you are now investing in the real estate sector into a stream of income flows that are emanating from either commercial or residential assets. Like I said earlier, we have a fascination with owning the property ourselves. So if you are a bit of a savvy investor who's saying, look, I want to diversify my risk, I want to put my money in government paper through infrastructure bonds or just government treasury bills, I want to put my money in real estate through a real estate investment trust that's well managed, then that becomes a really suitable option. However, if you want to hold property on your own, then one of the ways I'd say it is, purchase your property, but give it to a well-established management company, real estate management company, that can then be willing to give up 10% of the monthly income or the annual income. Because be professional. I always say cheap is expensive. So if you want to go cheap and try and manage it yourself, you're going to burn. But if you're willing to go professional and own the real estate yourself, then there are institutions like well-established, what do you call these, agents, not agents, what do you call, I'm trying not to say names of certain companies so it doesn't look like I'm trying to do a plug, but you know who I'm talking about, the large property managers who can manage your property for you at a fee.
Okay. Thanks for that. Maybe I can come. Oh, sorry.
No, go ahead.
Okay. Thanks, Thuranira. Just to to build on what Carol has said. I think broadly, if I move on that continuum of liquidity, as to how an individual can, in the diaspora or wherever, can be a real estate investor. Of course, on the most illiquid end is I buy a piece of land. There are pros for that. There are cons. The con there being it's a very liquid asset. I can't quickly sell it without losing much of the value. Or I can buy the land and build. There are pros. When I build, my yield is much higher. My cost is lower. But of course, there are cons to that. I'm taking development risk. I can buy a completed unit. So there's a yield compression there, but I don't take any development risk. And to Carol's point, if I'm working with my space or whoever, they can manage the unit for me, and I'm a very passive investor. And as long as I'm working with an institutional developer, then I have no queries or qualms about buying off plan and paying throughout the construction process. On the other side, and I like Carol's point, because this has been ignored most, is I can also be a real estate investor, not directly through ownership of a physical property, but by investing in financial instruments where the underlying is real estate. Carol rightly mentions a real estate investment trust. I'm just a fractional owner of a building, but what I'm holding is a financial instrument that is very liquid. At the moment in this market, there is now a lot of potential REITs that are being incubated, and that will provide opportunities for those who want much more regulated but highly liquid instruments that expose them to the industry without necessarily taking some of the risk that otherwise I would be taking either in an illiquid piece of land or development risk. Alternatively, if I don't want to invest in REIT, I've seen even a new emerging trend where I'm subletting, I lease a number of residential units, I convert them to Airbnbs, and I make that markup. So I think between one end of the continuum on liquidity to the most liquid asset, the most liquid sort of instrument, there are quite a number of opportunities that one can invest in. On financing, I think we are now at a point where a number of top banks in the country have specific mortgage products targeting the diaspora community. I think KCB, Stanbic, I think National Bank, they do have very specific diaspora targeted mortgages, even in hard currency. The issue of mortgages has been a topic in our industry for some time. Why in a country of 50 million, we only have less than 30,000 accounts? And I think we as investors, even we who might probably have the money to invest without going through the mortgage route, are missing an opportunity here. Ever since this KMRC was introduced, there has been an opportunity, what I would probably call an arbitrage opportunity. Today we have mortgages in Kenya shillings below 10% on one side. On the other side, you have typical yields on residential properties that are somewhere between 8 to 10%, which means if I'm paying a deposit for a house, say 20% deposit, and I take a mortgage for the 80%, and that mortgage is below, it's the 9.5 or 9%, it means my monthly installment is likely to be, rather, my monthly rent is likely to be higher than my monthly installment, because the interest rate now under KMRC mortgages is almost equivalent to the yields. And therefore, I can be able to, just for 20%, lever my acquisition. It's almost like a leveraged buyout, lever my acquisition, and my tenants end up paying. I think that's if you're structuring real estate as a professional investor, that's an opportunity that if I'm in Kenya or I'm in the diaspora, it's an opportunity a good number of people are missing. But I suppose financing is no longer a constraint, whether in the diaspora or in the country. There are specific products that are now, are in the market that one can use.
Sam, I just want to, if you don't mind, if I could just say, Sam, we just also need to be careful because these mortgages that are showing below 10% are typically fixed rate mortgages. So it's 10% fixed rate as opposed to on a floating rate. Yeah, so that you end up paying more than on a reducing balance. So when it says 10% fixed rate, when you say you pay the same amount over the lifetime of the mortgage, vis-a-vis on a reducing balance basis, which recalculates what the outstanding mortgage is. So 10% fixed might actually end up being about 15 to 20% on a reducing balance. So I just want to throw that caution in there. People need to understand.
Okay, yeah, and I think and allow me to add in some overly simplistic terms. If you structure it right and you've invested in the right property, essentially someone else can buy it for you, by leveraging rental income and such, to where your out of pocket, it would be very minimal, correct?
Exactly.
Can I add, Andrew?
Sure.
Yes, absolutely.
I just wanted to fully endorse and concur with what Sam and Caro did share. The financing options, the mortgage options, in fact, the refinance option perhaps is a facility that, to the best of my knowledge, hasn't been sufficiently utilized by diasporas. But the other option is borrowing cheap. In the West, you're talking of as little as 4% interest in hard currency terms. So why not borrow a little more and invest where you could, as has been narrated, you may be lucky, you may be able to earn 2 digits in terms of interest, which you don't get in the West. So that's what I wanted to add, the opportunity to even borrow and then bring home for better returns. Over to you.
Awesome. Well, thank you so much. And Mwenda, I want to throw the next question over to you. What types of properties, what types of, I guess you could say, real estate investments are you really seeing, fire from the diaspora in, whether it be, rental apartment units, commercial properties, land? Where are you seeing a lot of momentum at the current time?
Okay, having been a diaspora myself, I lived in America for 8 years and I did some investment while away. So, it was a big challenge, but I was lucky to have like a relative who understood the business. But they did it, but not to my level best. But I thank them for doing that. But I will really emphasize on using professionals when investing in real estate. And for example, the way I advise my clients, since I have friends who I lived with in diaspora and I've had so many horror stories, is when you invest in any other business, apart from real estate, business like the one you have to run every day, of course, here in Kenya, we'll steal money from you. We'll keep on pumping money. But real estate, at least if you buy land, one piece of land here, one piece of land there, apartment at Vida, and something else, of course, within time, you'll have a big portfolio of real estate. Like, for example, you have seen now the young generations, they are more into mixed-use developments, where you have like apartments where people live in, then the offices where they can work, and the restaurants and social places where they can go. The young generation don't want to move around a lot. In fact, they work in their computer, in their apartment. They come for a meeting downstairs at a restaurant and the day is gone. So mixed use development, I've seen it happening, especially in high-end areas. But if you go further away from the city, you see people are more preferring like own compounds and stuff like that. But the young generations, they are not much into that. They want convenience.
Okay, interesting. And, I guess before we go any further, I just want to let the audience know, if you have any questions, please add them in the comments section. We will actually have a short Q&A here at the end of the conversation in a bit, and we'll address some of your questions. So if you have any, please throw them into the comments, and we will address them in a few minutes. Now, my next question, what tips would you give the diaspora for effectively managing a real estate portfolio from abroad? You can all answer this question. I don't know who to throw it to precisely, but Samuel, do you want to kick us off on that?
Well, I smile because maybe my answer should be don't try to. Depending on the segment of real estate or the nature of the asset you're holding, it can be a bit involving. And remember, at the core of this discussion is how can you make it a passive investment, a passive income investment. If today you own, a few apartments here in Nairobi or wherever, it probably makes sense to have a professional property manager manage them for you. A trustworthy property manager manage them for you, and send to you or send to a designated account the net rental income. So if you're working with the likes of MySpace, we also manage assets for those who buy with us. Or if you're working with any developer who, as an after-sales service, they manage the unit for you by, managing the rental, managing the tenancy, collecting the rental, managing the maintenance, and disbursing the money to you. That's probably the easiest way to do it. I can't imagine the headache of having to call your tenant every month to check whether they've paid. There's a maintenance issue, a tap needs to be replaced, you have to make calls to plumbers. It would be a headache, and it probably would beat the whole idea of real estate investment, which is primarily to make it a very passive investment. It's why we have property managers or asset managers who deal exactly like that. So my own advice is, deal with professional asset managers. It may come at a cost to you from a fee. There's a fee they would charge to manage it, but probably for the headache and the certainty in the way the unit is being managed, it's probably better. You may argue that I have a relative who can be my caretaker, so my cousin can be my caretaker. I don't believe people have had great experience with that. So again, I would go, when it's an investment, handle the investment professionally. I wouldn't see my real estate portfolio as anything different from a money market fund or an equity fund that I've invested in. And I would probably apply the same principles when I'm managing that portfolio.
Andrew,
Okay,
if I can give an example, my sister lives out in the diaspora, but she purchased an apartment, beautiful apartment in Valley Arcade, and it was part of a number of apartments and the developer became the property manager. And the whole point was they were looking for tenants who are coming from the multinationals, or multinational workers, professionals, expatriates. And that's what they built very high end with a view that whoever their buyers were people who are going to lease out to high-end tenants. So she moved in there. She went in and she lived there herself. And then one day they had, and the property company was very good at doing socials, because they were like, we're going to bring people together. These are international, most of them are expatriates. They don't know one another, so we're going to do socials. So she attends one social, and she comes out and she says, I can't afford to live here. When I came to discover what the other tenants are paying, she's like, I can't afford to live here. I'm moving out and I'm getting these people to come in and manage the property myself. I can't afford to pay that rent. So she moved out, and it turns out it was quite timely because within 6 months she left the country. But the property company has continued to manage the property all this time. And because they are the ones who bring in, because they have a certain standard and a look and a feel, and they tell everybody, if you're doing it as a serviced apartment, this is what it looks like. You will only purchase your furniture from this place. We will come in and do the repairs. So it becomes like a serviced apartment. And so you just sit back and wait for the revenues to come in. Is she paying a pretty penny for that? Yes. But does she sleep well at night, knowing that if there's a bulb that needs to be fixed, or if there's a leakage, if the walls are peeling because the pipes are leaking, that's not her problem. She gets a bill at the end of the month, and it's fixed. And so that model has worked very well. And there are a few companies that are in this market that are doing that. But my advice to the 120 something attendees I can see on this is, do your homework, do your due diligence, speak to other people who have purchased properties from these property managers. What has their experience been?
Okay, and quick question, talking about property management serviced, units and such, just what does that cost, I guess, in a basic example? If I have a unit here, say in Kileleshwa, that rents out, about 100,000 shillings a month, how much can I expect to spend on that property management? Then how much, I guess, extra would it cost if it was a serviced building over just a managed building?
So for property management, usually it ranges between 3 and 10%, depending on the work which needs to be done. There are some properties which have a lot of work, and there's some properties which are just easy. People pay rent with no problem. But my advice to the people who want to be property buyers, the way you handle your life professionally, like when you're sick, you go see a doctor. When you want to learn something, you go see a consultant. Please, when it comes to your investment, handle it professionally. Use the right guys, do your research, and you'll not regret, and you'll sleep in peace because your property is being taken care of by somebody who cares.
Okay, interesting. Dr. Shem, everyone else has added their advice to diaspora investors. What's your advice?
Thank you. Often we're reminded by the professionals that due diligence is not just checking the title deed. It requires much more than that, and I fully concur. Utilize professionals as much as possible, but also to the extent that diasporas can utilize technology. If it's the REITs, work with the partners that give you regular mobile updates on how are your stocks performing. So that's utilizing technology. But even for diasporas who choose to construct their own buildings, CCTVs are one easy way. I do know diasporas who are also involved, although there are some problems here and there with phone farming or video farming, but they're able to see. It doesn't give foolproof comfort, but utilize as much technology as possible and utilize professionals. As Kenya Diaspora Alliance, one of the things we're doing, we have what we call a build consortium, where we rally a couple of credible legal professional groups, lawyers, surveyors, civil engineers, architects, and we're looking into reaching the other segments in this sector so that within the consortium, you have a one-stop shop that can be a bridge between major developers like Vida and others to give comfort. But lastly, just to say also, we've done roadshows outside the country. We've found them very effective. In-person engagement with the diasporas, town hall meetings, where they ask what we call in Swahili, umuntu kwa umuntu, face to face, so that they're given comfort. Perhaps going forward, this is something I can guarantee this year we're going to do a little more than we've done in the past, hopefully with a few of those selected real estate firms, so that we also get feedback. Because sometimes we may assume we know what the shoe wearer knows, the diaspora wants, but the shoe wearer knows best what they need. So some kind of back and forth engagement, face-to-face, virtual plus face-to-face is something that we advocate. But yes, we cannot overemphasize enough, utilize professionals. Thanks.
Okay, and a lot of individuals, also look at options like Airbnb and such, besides leasing, to turn their investment profitable. What are your thoughts on that? I know there have been mixed stories over the years of, is Airbnb safe? Is it not? You've also heard stories of people making a lot of money on Airbnb and other people struggling. I'm curious, Samuel, specifically, I guess, with Vida and such, what has been your experience with Airbnbs?
Okay. That's a great, way of looking at the real estate investment. It's basically a hospitality play that has now moved from traditional hotels, the hotel industry, to you and I being hospitality players. If you look at our industry, primarily, up to 90% of people who buy properties from us are what we call investor buyers. They're not home buyers, they're investor buyers. And I'm aware a significant portion of them have converted their units either into serviced short-term rentals, few weeks, 1 month, couple of months, or Airbnb. What a hospitality play does for your unit, it significantly enhances your yield. If I look at the Vida apartments, which are completed, and from discussing the number of investors who own the apartments, anybody who is doing serviced apartments or an Airbnb play is looking at anywhere between 15 to 21% yield or annualized return on their properties. Now, for real estate, that's really, really high because your typical yield on an unfurnished unit, just like on commercial rentals, is roughly 8%. So for you to be able to double it, that's it's a very good investment. In fact, it's significantly above bonds at the moment. So I think if you're looking at it purely from a return perspective, obviously it's the way to go. Is the demand there? Yes, significantly. For whatever reason, Airbnb has done well, and this is not necessarily for people visiting the city. Sometimes it's even people within the city probably preferring a weekend out. So Airbnb has been doing quite well in this market, and those who have mainstreamed it have even made it their core business. There are people whose core business is to either buy units for Airbnb or lease units and convert them to Airbnbs for an enhanced yield. Obviously, it does come with some operational challenges. I suppose if it's not a typical sort of tenant tenure, it involves a bit more of intensive management. If you're having, a weekly or monthly or a few months turnover in terms of tenants, it does involve a bit more a risk from an occupancy perspective. It does involve a bit more of, having to look for this tenant, having to clean the units, etc. And I suppose that's where you handing over the unit to professional managers comes in. So it's not your, day to day. But I would say it's a great opportunity. I think a lot of these affordable homes coming up in the market today are either studio 1 and 2 bedrooms, and you can see the target there is a hospitality play. It's a one way to just say now I run a sort of a hospitality business instead of just being your typical landlord.
Okay, and a quick question again for you, Samuel. Studios, 1 beds, 2 beds, which are typically the ones that you've seen sell out the fastest?
It's actually those three. It's those three, small units of between 24 square meters up to, say, 70 square meters. Studios and ones are almost 100% investment product for either, single individuals or people who are looking to do serviced apartments. And their returns are wonderful. If I use the example at Vida, the returns are really wonderful. 2 bedrooms sometimes tend to be serviced, but more often, a single individual or a very young family that is just looking to rent in the medium term, in a couple of years, as they then, upgrade to one day their home. So studios and ones, and I suppose also the entry price is affordable. For a studio going for 2.4 million, I just need to place a deposit of 240K. So the barrier to entry is very low. And that also drives a lot of the investments that we are seeing in the studios and ones. But I would probably say between studio 1 and 2 bedrooms, strictly speaking, the demand is almost on average uniform because they are typically investor products, not home buyer products.
Okay, well, thank you for that. And, I want to move and remind the audience, if you have any questions, please put them in the comments section. And if you weren't able to catch the entire conversation here today, this will be live on the Kenyan Wall Street YouTube page. like less than 5 seconds after we conclude this stream. So you'll be able to access it there. You can watch it there. You can come back, and if you have any questions as well, you know, you're always welcome to message myself or message any of our panelists on LinkedIn and such as well. That's always a great way to reach people and get some advice. Now, back to us here. I guess what do you foresee happening in the next 10 years here in Nairobi, specifically in regards to the sector? Forgive me.
The others can go before I go.
Ned, maybe I can answer a question that Ned Mburia is asking on the comments page related to that. And he's asking, is there a potential for real estate derivatives in Kenya? And, you know, if we take a step back, what are real estate derivatives? They come out as a result of you having a huge real estate stock. So you're trying to release that cash that's tied up in buildings, so that you can provide liquidity for the real estate developer to go back and develop more. Now, a lot of this real estate stock is coming through mortgages. So, for example, the banks, and this what happened in the US is you've got all these thousands of banks that are offering mortgages. So they've got valuable capital tied up in mortgages. So somebody comes, packages all of these mortgages, and then sells these derivatives so that they can release the money to the bank to go out and do more mortgages. And typically these were guaranteed by your Fannie Mae's and Freddie Mac's. That's a role of the Kenya Mortgage Refinance Corporation in Kenya, similarly, which is to be able to provide liquidity to the banks, so the banks don't have to tie up their own assets, or rather tie up their own deposits in lending to the real estate sector. So the KMRC will come and give a guarantee or may give liquidity to the bank. So similarly, you see that role. However, you need a large stock of mortgages in order for real estate derivatives to emerge. Right now, just looking on Google, we've got only 27,786 mortgages in this entire country. What does that tell you? Kenyans to prefer to buy cash or to buy land and then put up the building. So, you know, I'd be curious to hear from somebody like Sam, how many of his sales in all the entire stock that they have at Vida, how many of them are mortgage and how many of them are typically cash? So just to answer your question, Ned Buria, not in the short term, maybe not even the medium term. We're still struggling to get people to purchase real estate investment trusts, which is an instrument in and of itself.
Okay, thank you. So I guess continuing Carol's question for Sam, how many of your sales are cash versus mortgage?
Yeah. So we have two broad categories of products. We have the mid-market product. That's on price points between 7 million to say 17 million. And we have what I'd call the affordable portfolio between 2 million up to about 8 million. The 2 million to 8 million product is primarily an investor product. It's investor buyers. And to Carol's point, the source of funding for this kind of buyers is primarily savings. So what they're doing is, reallocating from one saving or from one asset class to another asset class, just happens to be real estate, which then would explain why Kenyans finance their real estate acquisitions through cash and not mortgages. It's primarily because it's an investment, and I'm just reallocating from, say, a money market fund or some sack of savings somewhere into a new asset class. On the mid-market product, if I use the experience of our completed projects, it wasn't more than 10%. So you'd argue, even for the more expensive ones, 90% of the buyers are still cash buyers. They're using their savings to buy and not mortgages. On your broader question on, what do we see in Nairobi's real estate or Kenya's real estate the next 10 to 20 years, I think we can play a scenario and look at the wider Nairobi metropolis today. And I would hazard to predict that what we call the Nairobi metropolis will now extend to Konza in that direction. So Konza will probably mark the last boundary in that area. A lot of great things happening in that city. If I drive towards Thika Road, now the city has expanded all the way to Kenol. Along that road corridor, you have two major cities coming up, Tatu City and Northlands. So along Thika Road, for example, you have three major cities or private cities. You have the Garden City development, where we are based. You have Tatu City, and you have Northlands, and it grows all the way to Kenol. Driving around Kenol, there are people today who live in Kenol, but work in Nairobi. Along the main Waiyaki, the city has now expanded all the way to Limuru, and there again we have an anchor city called Tilisi. So I would say, despite some of the negativity you read about or you hear about Kenya's economic prospects, despite what might be economic headwinds in the medium term, we remain very bullish on real estate opportunities. I think if you look at the various segments of real estate, residential from affordable to mid-market, logistics, retail, especially the kind of retail that Mwenda does, there remains significant deficit from a supply perspective, and the economic headwinds notwithstanding will continue to drive demand and therefore supply from our side. So we remain bullish that significant opportunities from a developer perspective, but also that means from an individual investor perspective, remain. The call to the diaspora then is, if the real estate industry in Kenya presents these investment opportunities, certainly don't be left out. Nairobi is growing. The Nairobi metropolitan is growing into this very gigantic metropolitan. Take advantages of the opportunities which are rising from that growth, and don't be driven by any negativity about the prospects of the Kenyan economy.
Okay.
If I may add.
Okay.
Yes, I want to concur in, they say East, West, home is best.
Yes.
I know of a number of senior friends who retired from the UN working in Nairobi. Some took early retirement when they were to be transferred to other UN headquarters. So that just shows, if foreigners love Kenya that much, despite the challenges we have that every other country does. It's also in that regard that allow me just to mention briefly, affordable housing, that's one of the flagships of government. Despite challenges here and there, as a principle, it's a good one in terms of creating opportunities for the construction sector. And the experience for the older generation like myself, we kept hearing that there would be a bust in the market in land properties in Nairobi. I don't see it happening very soon. If there is one property that keeps appreciating, I think certainly land is one of those. So the real estate sector is one that diaspora should shy away from. But above all else, the passive nature of the investment. If diaspora was trying to run a matatu business, whatever, with all good intents, it would be too involving. Maybe lastly, in that regard, just to mention that, in this I'll also answer the question I've seen Rachel Mary does raise. One, that in terms of finding products, as Kenya Diaspora Alliance, we are pretty advanced in conversation with the Nairobi Securities Exchange to find appropriate products, preferably and if possibly hard currency based, and of course with the approval of the Capital Markets Authority. So something is in the works. We hope it will be announced before end of the year. Hopefully when we turn attention, as I mentioned, we started with the health sector. As we are talking, we have a running program to select medical insurance for diaspora of choice. So I don't think it will be end of the year before we do that for the real estate. Hopefully working with major partners, the leading partners like Vida and others, we could craft solutions that address problems of the diaspora. But I wanted also to say that diasporas are also not being passive here. Diaspora are actively involved. For example, in probably the biggest infrastructure project in the country, upcoming, Mombasa-Nairobi Expressway, where a number of technology cities will be built along the way. So I want to encourage diasporas and partners in the real estate sector to watch the space and be on the lookout to work closely with diaspora to bring not only capital, but also knowledge and skill that they can transfer back home. Over to you, Andrew.
Okay, Mwenda, you wanted to say something earlier.
Yes, of course. I want to add on the question you asked, where do we see real estate in Nairobi and Kenya in general in the next 10 years? So what I would say on this is, for one, almost a third of the world, of the youngest population, they're here in Africa. That means out of 4 people, 3 young people are Africans. So we need to prepare for this. And what we have seen happening in the Kasamet said, the units which are selling is bedsitter, 1 bedroom and 2 bedroom. Already people are not having big families. People are downsizing. And so is affordability when it comes to apartments and houses in general. So we're getting to see more smaller units and a bigger developments, of course, with many number of units. See a block with 200 units, 300 units, and going. That it seems the way the direction is going. When it comes to opportunities, of course, the areas around the UN, the Blue Zone, there's been a big talk about this UN body shifting to Nairobi. Hopefully it will happen soon. Our study is happening in June. So the Blue Zone, there's a lot of opportunity with like 6,000 people moving in the country. That means there's an opportunity for development. Also, I'm sure nobody will hold me to this, but the next biggest opportunity in development, especially apartments, affordable apartments, will be CBD. Some let's talk in 10 years.
PD.
It's an interesting observation, but I see where you're going, Mwenda. And also reflect on the point we made when we were beginning. The Nairobi metropolitan is growing by about 400,000 people on an annual basis, the wider metropolitan. The government has always estimated that we have a deficit of 2 million residential units and growing by 250,000 on an annual basis, which tells you even if the government was to meet its target of developing all the units they want to develop in the next 10 years, if we, the developers, implement our total pipeline today, there's nothing we can do in the next 10 to 20 years to meet that deficit. And what that means from an investor perspective is that there's a significant addressable market, and how can you then participate or capitalize in that particular market. That's for residential, but obviously with 2 million in new residential units required comes a requirement now for the type of sort of convenience stores or smaller malls that Mwenda is developing and managing. It comes the need for logistics centers to cater for the trade, the commodity needs of this household. So holistically, for a city that's growing like that, in fact, the risk is that we will not be able to develop enough to keep pace with the sort of population dynamics we are projecting in the next 10 to 20 years. I read somewhere, and it kind of scared me. By 2075, which is 50 years from now, I may not be around then, Nairobi will have about 45 million people.
Wow.
50 years is not a long period of. It's really short in the wider sort of scale of national development. So almost the entire Kenya will be living. The entire population of Kenya today will be living in the city. It comes with planning issues, but also I suppose you can then see the sort of long-term opportunities, investment opportunities that sort of dynamic portends.
If I can jump in for a quick minute, Andrew.
Please.
There's a question, again, we're talking about the future, and there's a question by Njeru Ndwiga. Njeru is asking if there's going to be a real estate bubble. Some people have been asking this question for the last 20 years. And you've got to study what develops. How do real estate bubbles develop, bubble bursts develop in the first place? Usually it's too much credit that's given to that particular sector, and that credit dries up and then all of a sudden people don't have access to that credit to be able to offtake. Now in Kenya, our real estate has been fueled for a large, and I'm happy for Mwenda to weigh in here, is people using cash to build the properties, all right? It's only your institutional builders like Vida who will probably be working with equity investors, and maybe there'll be debt on the back of that, but very carefully structured. But most of the developments in this country are largely cash builds. Some of it is hot money, and it's looking for a place to park. I'll say it, and it's looking for a place to park. And so you'll find that you won't have a bubble burst because people are quite happy to park their funds in that and wait it out and clean the money as they did. Or again, you also have to differentiate between residential developments and commercial developments. Sam has very articulately stated why he doesn't think there will be a property burst, because the population is growing. So on the residential side, maybe not. On the commercial side, about 10 years ago, we had over 1 million square feet of office space in Upper Hill. Now that's ridiculous, and I don't think all of that has been taken up to date, right? But if you're looking at the commercial retail, which is where Mwenda is, the space that he's playing in, which if you look at nowadays, petrol stations have become the new shopping malls. And that's the interesting space. I'm curious to see whether there will be a bubble burst in that, because there's only so much retail that can be opened. But residential people always need a place to live. People don't necessarily always want to open shops.
Okay, thank you for that. Now, I do want us to take a few questions. So thank you, Carol, for helping me transition to that. And forgive me for getting your title wrong earlier. That was my fault. I take all blame on that. But we have a question here from Caroline. How do developers ensure that diaspora investors are protected from the impact of local cost fluctuations in construction materials while maintaining stable returns on their investments?
Okay. I could start, then somebody else can chip in. So in fact, and I suppose Caro, I can see Caro is a QS, so she'll be very concerned with costs, development costs. So Caro, I suppose when you have significant fluctuations over construction period, the risk lies with the developer, not you. Once you sign your letter of offer, you sign your agreement for lease at a fixed price, the developer has no alternative other than to deliver to you the unit at that price. So the moment you sign your agreement, pay your deposit, and you are compliant with your legal agreement, if the developer costs go north, it's up to the developer then to take that risk. So then argue, as a diaspora investor, once you fix your price, that's it. You have no risk whatsoever from the escalation. All the more reason then why you would need a strong developer, because what some developers do is once they realize, I'm having to take on higher cost and I had pre-sold at a fixed price, I then abort the project and disappear with your deposit. An institutional developer, in a worst case scenario, will even incur the loss, but ensure that they have completed the project when costs go north.
Yeah, I think that's a really good point to using a reputable developer, especially when you're buying. What's the term for it? I don't recall. When you purchase before it's built.
24 months typically. So you pay when you start constructing. Most typical apartments take 24 months, and the typical arrangement is you pay 10 or 20% as an initial deposit. You sign the agreement for lease, which is a legally binding document. Then you have roughly 24 months to pay up to 90%, and the last installment is paid when you hand over. A good developer will then keep you posted on a monthly basis through a newsletter or equivalent with real images of where the construction progress is at, just to remain accountable.
Okay, thank you. And we have another question here from one of our viewers on LinkedIn. Which is asking about demand outside of Nairobi. We've been talking about Nairobi a lot today. And if anyone listening hasn't visited Nairobi in a while, Nairobi is not just the county anymore. It is very sprawling all the way up to Limuru and such. It's quite a ways. Now, I think this is a great question. So I'm not sure exactly who would want to tackle this one. But what is your opinion outside in Nairobi?
Andrew, may you allow, before you go to this question,
Okay.
if you permit, the QS, the question that Sam very ably answered, the QS, the fluctuations in prices and all. I wanted also, just being a patriot, to acknowledge the fact that Kenya currently enjoys one of the lowest inflation rates. Of course, I recognize I'm not an expert in this space, I must admit, but the fact that we have one of the lowest inflation rates is something to look at. And also for diasporas who remit in hard currencies, ensure that you negotiate best rates when you have to convert. Don't just go to the next Forex Bureau or the next bank to change. Find out what best deals, because there are deals for foreign exchange. And lastly, in this regard, Kenya shilling itself has been fairly stable, thanks to the diasporas themselves. But be on the lookout for opportunities.
Dr. Shem, I think we lost you there for a second.
Yeah, so did you hear me when I indicated that get best rates for converting hard currencies? And then I just mentioned diasporas, make sure you get the best rate when you transmit into the country, and that the inflation rate in Kenya has been rather stable. But I did acknowledge I'm not a specialist in this domain. So for the diasporas who have stabilized our economy and our foreign exchange, pump in a little more, even if not for anything, to get a return and for the love of your country.
Thank you so much. Now, over to this question, outside of Nairobi, what is, your experience with demand in different facilities in different counties?
Okay, maybe I can help with that. I lived in Mombasa for 10 years, and of course, outside Nairobi, there are opportunities, especially like holiday homes, Airbnbs. And we have also seen houses coming up for weekends, like in Kajiado County, in Nanyuki, in Meru. And people are making pretty good money over the weekends, over the week, for furnished units. So for holiday homes, there are opportunities there. It's only that you need to let people more. You need to market more to the people out there. Like I've been on holiday around somewhere in Kajiado here. Very nice house, very nice place. I mean, and the amount is hefty. So there are opportunities out there.
And do you think those opportunities are largely just tourism focused, or there's also good opportunities in residential outside of Nairobi?
Mostly that is tourism focused. Since the people going for these furnished units, they are people who live in Nairobi or diaspora, people who come to visit. They are not people who live there permanently. Of course, the biggest pie of the cake when it comes to the economy and the spending power is here in Nairobi.
Okay. And I suppose Akinyi is referring to if I'm not wrong, Akinyi is referring to the Vipingo development in Kilifi. The demand, if I recall, when the project was being sold was quite high. My understanding from what is in the public domain, the occupancy is also okay. To your point about the yields, my general observation of the coast region is the yields are lower than Nairobi. And I suppose, it's just what it is. It just speaks to the different dynamics of the two cities. So, what drives occupancy and the demand dynamics in Nairobi are very different from what would drive the coastal region, and especially Kilifi. However, to the extent now, we started by speaking of the effect of this infrastructural development on real estate. What is happening in Kilifi today is the road between Nyari going towards Kilifi town, a section of it has been converted to a dual carriage, and the highway has now been expanded. Eventually, this road will be dualed all the way, at least to Malindi, the best of my understanding. But a portion of it is now completed. And what that means, today I can work in Mombasa and very comfortably drive to Vipingo or to Kilifi without what has been experienced in the last many years. The sort of congestion, especially around Nyari and Mtwapa, that has been resolved. My own prognosis then, you're likely to see significant move now towards, especially this Vipingo development, because it's well planned. It's a large mixed-use development relative to what is available in the coast. What was, sort of impacting demand negatively was the congestion in accessing it. Once you resolve the access, you will see a lot of then, people now, your ordinary tenant moving to the development. Also, that the development itself, I think it's put out as a large mixed-use development anchored on industrial parks. I've seen driving around that development, a number of industrial developments are already coming up. And therefore, gradually over the medium to long term, certainly the demand which would drive the yields higher will be evident. Now, to Mwenda's point, I think it helps to revisit. There are towns like Nanyuki or the coast which are very driven by tourism. What I've observed in what I would call the next tier of cities or next tier of towns, once you move from the top towns, the top 5 cities and move to the next 10 or so, because of devolution, you can now, driving around, see a number of apartments coming up. You and I realizing that there is a captive economic sort of area around those towns and building apartments to respond to that. It's observable. I wouldn't say it's large scale, but you can now see sort of young budding development, G+7 sort of storied buildings coming up. And that to me speaks to these towns or these devolved centers or units becoming economic centers in themselves. I think it's a trend to watch in the medium to long term.
Okay, thank you for that. I'm looking for another question. We have gotten a lot, probably 100-something questions. I know we don't have time for that. So let's take one more question from the audience, and then we will head out for the evening. And like I had said, if you didn't catch the full webinar, this will be on the Kenyan Wall Street YouTube page immediately after we conclude the stream. You're able to find it there. I believe you can also go back and watch it on X and LinkedIn as well. But I have a question here, and this seems to be focused mostly on Sam and Mwenda, but Carol, I'd love to get your thoughts as well on this, which is what are the biggest challenges that property developers are faced with today? I think this is a great question in regards to, being open and transparent as well as a developer. That's one of the ways you're able to maintain trust with your investors and with your buyers. So I'm curious, what are the biggest challenges facing property developers?
Yeah, let my colleagues go first before I comment. Mwenda, Caro, any views?
Caro, you seem to know that.
Mwenda, you know what I'm liking is how everyone's tossing this ball to, so, Sam tosses it to Mwenda, Mwenda tosses it to me. It's like a hot potato. I should just toss it to Shem.
Ladies first, but gentlemen before.
I know. They say beauty before age, though. So let me give it a shot. I'm kidding. No, the biggest challenges I would imagine is largely is financing. Interest rates are really, really high. When you've got interest rates in the double digits, starting in the 20% range for a property developer, I believe Sam spoke about the cost element to it. Trying to cap your costs while your financing costs are going up can be quite difficult. Your building costs vis-a-vis your financing costs. What will your offtake price be? So I would imagine right now for property developers is one, financing, and the second thing is is it an enabling environment? Today you put up a property. I'm speaking about the Kileleshwa. I just look at Kileleshwa, Kilimani. You're putting up a block of apartments on what was a beautiful road before, but with all the construction going on, the county is not replenishing and not repairing fast enough. So it looks like a beautiful block of apartments, but the road access to the apartment becomes a complete a hot mess. So then the attraction then becomes significantly difficult for you to attract the buyers that you're looking at. Just right off the top of my head, let me defer to my brothers here who are far more experienced in the sector. Mwenda, back to you.
Yes.
Now in studio.
Okay, of course, when it comes to development, there are two major costs, the cost of land and the cost of finance. These are critical to any development and to the pricing of any project. So, and the interest rate, especially when they jump, let's say from, like we had a time they jump up to 21, 24. I mean, that is crazy. It wipes all your profit if you were to make any. So the cost of finance is a big factor. And also the cost of imports, construction materials, especially when you go to the constructors. Somebody told me the other day, 3 days ago, that the cost of imports, the duty on import has gone up again. So this, of course, will affect us much. Like the cost of steel has been going up and up and up. Cost of cement has been going up. So all these put together affects the cost. Of course, those are the challenges we face in the real estate industry. And when it comes to commercial real estate, of course, you have to get, like, for example, anchor tenants. There are not many in Kenya. Like when you talk about supermarkets, there are like 4 major ones who we deal with. I mean, we need more options. When it comes to the petrol station, of course, you want the big brands. There are like 3 of them. So we need more varieties in Kenya.
Okay. Thanks. I could then add to that. Planning in Nairobi is something else, and whatever that comes with. I think when I went into this industry, I was a young man. A few years later, I've started growing white hair because of the challenges. So we do have some very significant planning and physical land use problems in Nairobi, and they're beginning to affect developers. And I want to link that back to the cost that Mwenda is speaking to. The cost of land in Nairobi is high. Let's just put it like that, probably one of the highest in Africa. So you buy this land expensively because it's priced on the basis of a high density development, say on Rafter Road or Kileleshwa. You then make applications for approvals. Of course, that is in itself something else between your application and actually getting the approval. It is one of the risks that as a developer you have to deal with. But there's an emerging trend today of very activist neighborhoods. So as soon as you get your approvals, and they're the right approvals because the land was bought, the pricing of land, especially in some neighborhoods today, reflects that it should be high density development. Then neighborhood activism sets in, and you then have to deal with that for a number of months. Some have even gone to court, and they stop your building, and you can imagine the capital cost of doing that. Then to Mwenda's point, it's one thing then to have a high cost when you're planning for a project and to pre-sell, as most developers do. When you pre-sell, you fix your price. Once you fixed your price, if costs become unpredictable, all manner of taxes come up, it means you, the developer, are having to take that compression off your profit because you still must finish. So on one side, you have a fixed price. On this other side, you have a 2-year development risk to deal with costs. Obviously, when we pre-sell, we presume all our buyers will pay faithfully within 24 months. That is something else. It's always a risk that you take, that not 100% of your buyers will keep to their payment plans, which then means you have to dip into debt sometimes. And as Caro well put it, it's very expensive. The last 2 years especially have been very challenging because of the monetary situation. When interest rates have been high, not only does it make it very expensive to borrow, it also makes it very hard to sell to you and I, because I will say my money market fund is making 17%. Why must I invest in a real estate product that will give me an 8% yield? So I suppose like any other business or any other domain, there are significant challenges. It is our work as business people, as business leaders, to then deal with them. You can make it easier for us, Gitao, and other people online, by at least removing the market risk. By buying and paying faithfully, you will have solved a third of our problems.
Okay. Well, awesome. Now, I have overkept you guys by 25 minutes, but forgive me for that. I think this has been a spectacular conversation. I didn't want to cut it short. And I think everyone, just watching the volume of comments roll through, I think, everyone is finding this pretty interesting conversation taking place. Now, before we conclude, I wanted to go through everyone, what are your final thoughts? If I am just now tuning into this webinar and all I get out of it is the next 3 to 5 minutes, what's the one takeaway that I should take forward in my life? Well, we can start with Dr. Shem.
Make sure that you utilize professionals to the maximum possible. And obviously to thank each and everybody who graced this event, and for you hosting and Mwenda co-hosting. Thanks for the opportunity. We look forward.
Thank you. Carol?
No, great webinar. I haven't done a webinar in a really long time since COVID, so this is excellent. I think, Andrew, let me stay faithful to what I've been doing, which is just touching base on what people are putting on the comments. There's somebody who's actually quite cheesed that we're not being serious if we're not talking about tenant purchasing schemes. So let me just make that comment to this gentleman, that the government has traditionally always done tenant purchasing schemes through the National Housing Corporation. So if you look at, there's quite a number of National Housing Corporation developments, and those are tenant purchasing schemes. NSSF used to do that. If you look at Embakasi, NSSF was quite famous at doing, in Vida Estate, if I believe it was Vida Estate, I believe it was an NSSF project as well, I can't remember, but NSSF used to do a lot of this as well. So the government's role, it's the government's role in terms of its housing policy to provide tenant purchasing schemes. And so I just want to just tell that person that they do exist. Andrew, this was a great webinar, and thank you.
Thank you. Mwenda?
Yes, I would echo what Shem said earlier, being a patriot. So if you're Kenyan, and especially you live in diaspora, you can't be a true Kenyan if you don't own a part of it. And owning a part of Kenya is owning a piece of land, a piece of apartments. And one thing I leave you with, in real estate, you don't wait to buy. You buy and wait. And that's why you need to call me Vida or MySpace Properties. Will get you sorted.
Thank you. Samuel?
Yeah, well put. I think the way I would look at investments, as an aspiring investor or an existing investor, you hold a portfolio of investment, and each category of assets within your portfolio serves a specific purpose. However you look at it, every investment portfolio that is well balanced and well diversified must necessarily include a real estate holding. And I'm not saying that because I'm a developer who is selling. I'm saying that because that's a sound investment advice I would give. Why real estate? Real estate is a store of value. Unlike all other classes of investment, it has a particular characteristic we call inflation hedging. Because the value, whether it's the value of your property or the rent over the long term tracks inflation, it is the one asset class that is hedged automatically against inflation. So you can hold it long term and not lose value. So however you balance your investment portfolio, make sure that you're looking at having near liquid assets. That's where your cash or savings account in the bank comes in. It serves a particular purpose. On the other extreme end, you have the more longer term real estate that becomes your store of value. Always remember it is inflation hedged. I've had this argument that real estate gives you a 10% yield, bonds are giving you 15%, therefore bonds are better. It's a false comparison. The fixed income nature of bonds means that the real return there is that coupon rate less the inflation, very high level mathematics. The real return, the return you get from real estate is what you call, it's real because it's inflation hedged. The only way you can compare with a bond is to add the inflation rate to that real return. So whatever portfolio you're building as an investor, make sure it includes some element of real estate. Then you can say you have a well-diversified and well-composed investment portfolio. Thank you, everybody, for listening. Thank you so much, Andrew, for this session.
Yes, and thank you to each and every one of you for taking now an hour and a half out of your day to come and help inform us on what's taking place in the Kenyan real estate space, how the diaspora is playing a larger role, and so forth. So thank you so much to each and every one of you. You can follow MySpace, Vida, the Diaspora Association, Carol, everyone, and the Kenyan Wall Street, of course, on social media and online. So thank you so much, and have a good evening.
Thank you. Thank you. Thank you.
Thank you and bye.